So hello, everyone. First of all, wishing everyone a happy Women's Day. Thank you so much for joining us for this exclusive session on goal-based investment strategies for women by women. And joining us for this session are senior wealth managers from InCred Wealth, who will guide us in this discussion today. They bring more than 50 years of collective experience in financial planning. So please welcome Arti Bhalla, who has more than 25 years experience in banking and financial services. She has worked with reputed names like HDFC Bank, American Express, Standard Chartered Bank, and Deutsche Bank. Welcome, Arti.
Thanks, Bhavna. Pleasure to be here. Wishing all the lovely ladies out there a very happy Women's Day. Though I do believe it's our day every day. Thanks, happy to be here.
Great. Our second guest is Gitika Mehra, who has more than 2 decades experience in the banking industry with expertise in retirement planning. And she has worked with financial institutions like ABN AMRO, Client Associates, Deutsche Bank, and IIFL Private Wealth Management. Welcome, Gitika.
Thank you, Bhavna. Lovely to be here and wishing all the ladies a very happy Women's Day.
And our last guest is Mukta Khanna, who has 15 years experience in the wealth management space, managing portfolios for ultra high net worth individuals in the country. And she has worked with known names like IIFL Wealth, Citibank, and Kotak Securities. Welcome, Mukta.
Thank you, Bhavna. Thank you for having me here. Happy Women's Day to everyone out there.
Great. So we have literally a very impressive lineup of guests for this session. So without further delay, I will directly jump into my first question, and that is for you, Arti. In your experience as a financial planner for so many decades, right? How have you seen the role of women evolve?
Thanks. So as you all know, women have been excelling in areas like the arts, sports, science, medicine, governance, and climbing corporate ladders, and how they have been winning the world, as you know, with their beauty and grace. They have been landing in space and beyond. So as women, we all have come a very long way in empowering ourselves. Over the last 25 years that I've been working, I've seen more and more women now actively contribute to household income over and above their contribution to the house as homemakers. We see many more women entrepreneurs wanting to take their business to the next level. You know, startup is the buzzword, and we are happily seeing so many women-led startups. Yet, when it comes to handling finances, for some reason, a lot of women still leave it to the men in their lives, their husbands, brothers, or even friends. And while many women are understanding the importance increasingly of being financially independent, I don't know why some of us lack the confidence in our own ability to manage our finances well. So my question is why? I think all of us women should know, we should believe that we're equally good. In fact, we are much better at making very sensible money decisions. And we all sort of get very excited to attend workshops, you know, on fitness, fashion, anti-aging. So my sort of, you know, bit is that why not spend a little time and improve your involvement and knowledge of basics in investing for a better future for yourselves. Though I must admit that, you know, the trend of women you know, investing or taking greater control of their money has been increasing, to some extent accelerated by the economic impact of the pandemic. In fact, there was a survey done recently by a digital wealth firm, only in the metros though, which showed that 1 in 5 women had stated that they had started investing for the first time during the pandemic. This is heartening, but a lot more remains to be done. And I do believe it's extremely critical for women to be involved and ideally manage their own financial plans.
Thanks, Arti. I think the stat that you mentioned was indeed very encouraging. So moving on to my second question, and this one is for you, Gitika. Why is financial planning so important? We know it's important. People keep telling us, right? So can you like spell it out for us? Why is it important, especially for women, to plan their finances?
Bhavna. So, what is financial planning? Financial planning is a step by step approach to achieve one's life's goals. It's like a guide taking you through life's journeys. Why financial planning, you may ask? I mean, and let me take you through 5 different reasons, the most important being financial independence. Like Arti mentioned, women are scaling heights in various walks of life. But even today, most of them depend on their parents or husbands and then children financially. So, this is the time to actually change that. And most women want to become self reliant, to enjoy the sunset years, pursuing one's hobbies, traveling, doing things they couldn't do while they were younger but busy, and also give them the strength to deal with unforeseen circumstances such as untimely demise of a spouse, layoff, divorce, etc. Another important factor to note is inflation. Uh, we've all seen, salaries being cut during the pandemic, inflation being high, and inflation is the hidden enemy of your wealth. It doesn't allow you to buy the same things which you can buy today, tomorrow. Inflation in India over the last 5 decades has been at an approximate 7.7%, which is huge. For example, 1 liter of petrol in 1990 was about 10 rupees. And today it's over 100 rupees in many cities and likely to go up in the next few days. Longer life expectancy. Today's generation is likely to outlive the previous generation due to better living conditions, medical facilities. In fact, as per a study by the UN, women tend to outlive men by a minimum of 3 years, which makes it imperative to have proper financial planning in place. Medical emergencies. I'm sure all of us have experienced either in the family or with friends, emergencies taking place and draining all your reserves. So it's important to start early and plan for such emergencies, because while retail inflation is at 7%, healthcare inflation continues to rise at over 10% in the country. And lastly, but definitely not the least, there's a huge gender pay gap between men and women globally. And in India, it's at an alarming 19%. So, and while women have lower career spans thanks to having a family, looking after aged parents, it's important. I cannot stress enough the need for financial planning and better retirement readiness.
Thanks, Gitika. I think that was indeed very insightful. Those numbers that you shared were really eye-opening. So moving on to my third question, and that is for Mukta. So Mukta, what are the components of financial planning?
So Bhavna, let's get started to the crux of financial planning for women. Though there are various components, but I consider these 5 components to be most important for financial planning. First one being setting up your financial goals. Your financial goals has to be bucketed into 3 categories: short-term, mid-term, and long-term financial goals. These could be for anything. Either it's for buying a house or traveling abroad, setting up your own business. As Arti mentioned, a lot of women are nowadays going towards setting up their own startups, or chipping into the family money for taking care of the kids for future, their education, etc. So you set up the goal in your mind for each of these goals. What's the kind of money that you are going to need? Once that idea is there on your mind, you move on to the next important aspect or a component of a financial planning, which is what I call is identifying your baseline. You should today know, where does your assets and liabilities stand? Now, your liabilities could be your credit cards, your loans, mortgages, etc. And your assets are typically your investments, real estates, any valuables, etc. You just subtract from your assets your liabilities and come to know, where do you currently stand? What is your current net worth? Then you look at the third most important component, which is budgeting your cash flow. Now, today we all know what is the kind of expenses, what's the kind of money that we need to spend on monthly basis for taking care of ourselves. All you need to do is that, say for your goals, 10 years later, 15 years later, 20 years later, what's the kind of money you are going to need for spending on yourself or maintaining the same lifestyle. So you have to account for inflation, extrapolate these numbers, and estimate what is the kind of cash flows you are going to need 10, 15, 20 years down the line. The next most important component of financial planning is when you take up a career break or you go for a retirement, what's the kind of corpus you're going to need? So you have that particular corpus in your mind. And lastly, which is a very important point and which I always harp upon with all my clients, is that you have to cover yourself up for 6 months of income-less existence. And this is the kind of money that you need to put into the liquid assets or the bank deposits, etc., so that you have an access to this money at the time of trouble. Once all these 5 components have been jotted out on the piece of paper or on the spreadsheet, you move on to something very important, is what we call the asset allocation. That's when you decide with your risk-taking ability, where should you be putting your money, whether it's debt or the equities, where in the life stage you are in, where would you want to put in which particular asset class.
Great, Mukta. I think that's very helpful. I think you laid it down really stepwise. You bifurcated it really well for us. So thanks for that. One point that you mentioned in this is asset allocation. Even as someone who, as a person who invests, even I hear this term so often. So Arti, can you clarify what exactly is asset allocation?
Sure. So, asset allocation, very simply put, means diversifying across different asset classes. You would have heard very often, don't put all your eggs in one basket. That's what it really is. So broadly, there are these 4 asset classes, as you would see, and you would have heard of. So there is debt, there is equity, there is gold, and there's real estate. Each of these asset classes has its own inherent risks and returns. So if you see here on this spectrum, we'll just share it on the next slide. You'd see that, there are debt instruments which we've shown here, which are lower on the risk spectrum, but also lower in terms of returns. So debt instruments would typically be things like bank FDs, company FDs, corporate FDs, government or private sector corporate bonds, debt mutual funds. These are some of the instruments available in the debt as an asset class. So debt, when you invest, debt is lower on volatility, but as I mentioned, also lower on the returns. As we move along the risk spectrum, you see that equity allocation, which would be in equity mutual funds, could be stocks, will give you higher returns over a long-term period. And this would help, beat what we were talking about earlier, about beating inflation. So equity as an asset class may be volatile in the short term, but over a longer term period, it helps you beat inflation. And just to add to, what Mukta and Gitika had also touched upon earlier, we hear about inflation. So there is one inflation data which is published by the government, which would vary, say, between a 5 to 7 or 8% figure. But what we need to realize today as consumers is what we experience is lifestyle inflation. So for example, 10 years back, or maybe a little more, an aloo tikki burger would have costed something like, 20 rupees. Today, the same burger is 45 or 50 rupees, something as basic as that. If I were to buy myself a crepe sari that costed me 1500, today that same sari would cost 6,000 rupees. And then so many other lifestyle expenses and goals which we account for, school and college fee, cost of air travel, family entertainment, all of these have actually grown as per various studies done anywhere on an average between 10 to 12% per annum. So our long-term goals, which we all make, have to actually be aligned around beating lifestyle inflation. And to achieve our financial goals, we need to have allocation to debt and equity. We should have more allocation to debt as an asset class for short-term goals, higher equity allocations for achieving our long-term goals. So that's where the asset allocation fits in with the short and long-term goals.
Great, Arti. Thanks for really decoding it for us. I think that really helps. So now moving on to the crux of our discussion, right, where we said we're going to talk about goal-based investment strategies. So I have one goal for each one of you, and you all can sort of, help the attendees understand how they can go about backtracking from these goals and preparing their investment strategies. So I'll begin with you, Mukta. With more than 15 million businesses in the country being led by women, women entrepreneurs indeed have the potential to be the biggest force in India's economic growth story. So what would be your investment strategy for someone who has an entrepreneurial streak, who wants to start up her own business? How can she go about that?
So Bhavna, my advice to all the entrepreneurs or wannabe entrepreneurs out there, whether it's men or women, would be just the same. First thing, which I mentioned earlier also, is knowing your financial goal. Here, I would just like to, change the words and say, know or get an estimate what is the kind of money you are going to need to run the business. So if you know mentally that you are ready to put X sum of money into the business, you have to work towards that X sum of money, or you have to create a kitty towards that X sum of money. All you need to do to create that kitty is to become a master of savings. I always tell this to everyone that, go frugal, do not spend too much. And if you can look at putting in the money systematically into the various asset classes where you are more comfortable, and if you are looking at setting up a business in, say, 3 to 5 years, yes, you have to focus more on the debt as an asset class and lesser on the equities. But at the end of the day, you have to achieve a certain kitty for your business. So you do that. I would say you have only few years to earn before you set up your business, because earlier, as soon as you set up your business, first few years, you're not going to have earnings. You are going to put in the money only into the business. So try and increase your earnings. There are various modes to do it. Other than your job, try and take up some extra work, which can actually help you increase your earning. And whatever extra you are saving, just keep on investing so that you are able to achieve your first goal, which is what is the kind of money you are comfortable or you're ready to put into the business. And then comes, at all point of time, remember that you have to put in that emergency funds separate aside altogether, because there'll be that money that you are going to need when you will set up for your business, because initially there is going to be no earnings. And most important aspect is that while you're working, you end up taking up your health insurance policies and your life insurance policies at that point of time itself, because the moment you go into the business, it's going to be difficult, taking up a life insurance plan, because there'll be no cash flows that will be coming in initially. So take up those. I think that will be the piece of advice for somebody who's aspiring to become an entrepreneur a few years down the line.
I think, Mukta, that is indeed some great advice. I just want to tweak this a little bit, and I want to ask you, what about those who've just started up, who are fairly new into their own entrepreneurial journey? Do you have any piece of advice for them?
It's a very tough question, Bhavna, because somebody who has just started up the business would be cash strapped, and there'll be erratic cash flows that will be coming in from the business. But I cannot harp enough on the fact that, even if you have erratic cash flows, even if you have smaller monies that are coming in, trinklets that are coming in from the business, be systematic about doing your investments. Look at doing SIPs into the mutual funds. Look at putting in the monies, smaller monies into the debt mutual funds. It's all right, even if it's just 10,000, 15,000. Remember, there's a power of compounding that is going to work on these 10,000, 15,000. And even if your finances or your investments multiply by 15% per annum, with the compounding, the returns are going to be extrapolated at the end of the period when you're going to look at it. So smaller also, put the money into channelize it into the financial market. I would, normally when you meet up the, new entrepreneurs, one thing that they always say is that this is what they need and this is what they want. So create that particular bifurcation at all point of time, because you are new to entrepreneurship. So you should know that what is it that is required, or which is something which you can't let go of. It could be, your electricity, etc. But there could be certain luxuries which you can look at, maybe buying at a later date or splurging into those at a later date. So, the buzzword is that you go frugal. All billionaires do it. First 3 to 5 years of setting up a business is very difficult. It's not easy. So rather than depleting into your cash reserves, I would say that, spend as less as possible. And, here, I remember this quote of Warren Buffett, where he always says that do not say what is left after spending, but spend what is left after saving. So that becomes very important. It's critical. Like I said, that, first 3 to 5 years will be tough. Make sure that you're covered amply, because protection will play a major role. We all know during the COVID times, or the kind of health emergencies that can come up at any point of time, you don't want to dip into the monies that you have saved, and you remember that at this point in time, you are not going to earn too much when you're just setting up the business. So look, that has been done. What I also point out to most of my clients at many times that, and I use this particular phrase for them, which I say, out of sight, out of mind for the money. So whenever there is a dividend that is declared in your company, or whenever you have got a lump sum money that has come to you, try and putting up that particular entire money into the financial market or into the physical asset then and there, rather than letting it be in your bank account. Because that money, once it goes out of your sight and it has gone, or it has been channelized into some kind of return generating asset, you are not going to spend it. You know that it's going to generate some kind of returns to you. And lastly, I would like to definitely point out that, we Indians somehow always used to shy away from taking up loans in the earlier era. But these days, there are really attractive rate of interest that are available for you to take up loans. And especially if you're a women entrepreneur and who is going for businesses, there are special interest rates available, etc., for the women entrepreneurs. So go for taking up business loans, etc. You don't need to dip into your entire savings on day one itself and you have started up the business. And, we all know that, and I think I'm just going to take up that clue from Arti, that women are better savers. They have got a better credit score also. There was a study that happened very recently, which I read in one of the papers, that women in general have got a credit score of upwards of 720, and that actually make them more suitable candidate to take up the loans.
Perfect, Mukta. I think that is indeed very encouraging. So all those who are actually planning to start up, I think this should really put them in a motivational space. Thank you so much, Mukta, for taking up this goal for us. I'm going to move on to Arti. Arti, my question to you is around single women who are working and they, run the household entirely by themselves, whilst they also have a certain lifestyle to maintain. So what would be your advice for this audience set for us?
Yeah, very important, and something that I'm quite passionate about, especially because I do happen to have a lot of clients who are single. So I'd like to sort of divide this into two subcategories, Bhavna. There would be single women, and there'd also be single women who are mothers, So the goals for single women would be different depending on the age and stage of their life. So, young women in their 20s, and our advice would be to, start saving and investing, as we spoke earlier also, like you could start in college with the pocket money if possible. And so for young women in their 20s, their goals could be things like, possibly higher education. Long-term goal would be buying a house, planning a fancy wedding. Some girls want to have destination weddings. So, it would differ for each one really. But depending on whichever are their short-term and long-term goals, they would need to keep that in mind. And obviously at a younger age, they can afford to have a greater risk appetite. So they can, invest a higher portion of their savings into long-term, for equity, as I mentioned earlier as well. And like Mukta mentioned also about, saving, very important that once the money comes in, you actually invest it. And if you do your financial planning well, you'll see that to reach your long-term goal, you will require considerable savings. So, when you're younger, you need to sort of keep that in mind and save and invest. For older single women, goals like retirement planning, more of health insurance, building the emergency fund, all of that would become important goals. And, probably a higher allocation to some debt instruments for short-term goals would be required. Then we should look at single mothers. So for single mothers, the goals change slightly because their focus will obviously be oriented towards, raising the children. While I've seen that, women, the way we all are, we would focus on sort of investing everything for our children. The single mom should not forget that for her, retirement planning and saving for her own future is equally important. So she would have to set aside her longer term goals, split it up into higher education for children, for her own future. And at times, single mothers would also have responsibility of older parents. So there one needs to invest more into taking a family floater kind of a health insurance plan, where the parents could be covered and, the children and the single mother. So more budgeting would have to be done in such a way that money goes towards buying health insurance, life insurance, especially if she's the only earning member, since she is, and if there are young dependent children. I think very important to keep that in mind. And of course, we already spoke about the emergency fund. One thing I'd like to add of course, that's for all parents, but all the more so for single mothers. There are these, children plans, which many of the mutual funds have, where you could get a combination of investment and insurance. And some mutual funds also have special, children plans. Most of these plans have long-term maturities, lock-in dates, so that it gets aligned to the goals of higher education, marriage, and you're not tempted to withdraw out of that. And you can systematically keep putting that money away monthly. So it's a good sort of substitute for, what I think our mothers or our grandparents would have done when we were all, younger, like put in, a recurring deposit every month, which is not a bad thing, I think, even today, but it's just that unfortunately bank FD rates today are, eating away into our purchasing power. So it makes sense to put in something into these children plans, which are more equity oriented, to help achieve those goals, really. So I think that would be my advice for single mothers and single women.
Okay. Arti, I just have a follow-up question. You mentioned that single women, they should start early, they should put in some of their salary in various investment instruments. Ideally, what would be a good percentage of one's salary to invest? Is there any such golden ratio or something?
Well, it's again hard to fix a ratio. It would depend on what, the monthly expenses are. And like I think Mukta spoke at the outside, that once you identify, your income, take away your monthly, quarterly expenses and whatever remains. But ideally, when we generally speak, they say that, okay, 50% at least should get saved and invested, and 50% can be used for, monthly expenses. So I think at the bare minimum, if one is able to do that, or at least that's the goal one should work towards, I think that's what should look at.
Great, Arti. I think that's sort of helpful. So just an add-on question to the first question that I posed for you. We spoke of single working women. How about those that are married and they are actively contributing to the household? Any advice for this audience set of ours?
Yeah, so I think we see more and more of that. I think especially in the metros now, and given the lifestyle spends we spoke about, doesn't become imperative actually for couples to work. So I think the advantage here is that there is a dual source of income, right? The husband and wife are both working. So expenditure and investment goals should actually be divided in proportion to the earnings. There needs to be a clear demarcation. So, for example, the husband may choose to take care of certain monthly expenses like a loan EMI or rent, utility bill payments. The wife may choose to, this is just an example. Wife may choose to spend on family entertainment, any other miscellaneous expenses. And then whatever the household savings are there should be invested for the short-term goals and long-term goals. And those would be similar in the sense short-term goals would again be things like maybe, family holidays or some of that. And long-term goals could be things like buying a house, children's education, and all of that. But here, since there is a dual source of income, one should sort of not, thrift it away, but actually save it and actually, use that to the benefit to invest in health insurance, life insurance, because I think these days you hear many people talking of wanting to retire early or do their startup. So it makes sense to invest aggressively for long-term goals so that in case you do wish to take an early retirement, you could do that. And with the dual income, that benefit, we should take advantage of that.
Great. Thank you so much, Arti. Now, moving on to our third goal. It's often a very neglected goal, something that people think कि हम बाद में कर लेंगे, देख लेंगे बाद में. That's the kind of reactions I've seen from people usually. So we're going to talk about retirement planning, and Gitika, I will come to you for that. Please take us through your advice for retirement planning.
Yes, like you rightly put it, Bhavna, this is something that most people put off for a very long period of time. In fact, this is something that people have to start right in the beginning because you never know what kind of things come up during the journey of life. So retirement planning is important. And like they say, as in all successful ventures, the previous slide. Like in all successful ventures, the foundation of a good retirement is planning. And how do you do your retirement planning, basically? What is it that you need to understand to do good retirement planning? I think the one point is power of compounding. Compound interest is the eighth wonder of the world. She who understands it earns it, and she who doesn't pays for it. This is something Albert Einstein had said. And let me show you why power of compounding is important to understand and how it can make your life very easy. Next slide, please. Do you know that the value of 1 lakh invested at 15% per annum takes about 5 years to double? That means it becomes 2 lakhs in 5 years, 4 lakhs in 10 years. In 20, it becomes 16 lakhs. And in 30, it becomes 64 lakhs. That is the power of compounding. The longer you stay invested in the markets or whichever asset class you choose to, whether it's fixed deposits, gold, property, the longer you stay invested, the higher the power of compounding and the higher the return you make on your investment. You can have the next slide, please. So you may ask, where do we start? And like Bhavna was asking, is there a golden ratio or something? But let's say, to give you, to put things in perspective, if we were to start saving 50,000 rupees a month over a period of 5 years, that would be 30 lakhs invested over 5 years. Every month, 50,000 into 12, that's 6 lakhs. 6 lakhs into 5 is 30. So at an average return of 12%, you would end up at about 41.25 lakhs. Double the time horizon and obviously double the money. 60 lakhs grows to 1.16 crores. And that is more than double, right? Go double from there, which is 20 years, 1.2 crores invested. And I'm still talking only about 50,000 rupees a month. your corpus will end up at about 5 crores. And again, this only shows the longer you stay invested, the more money you make. Power of compounding. You can also work backwards. You can set a goal that I want to retire in 15 years with a 5 crore corpus, or 10 years. Like Arti mentioned, a lot of people want to retire early. So you can set the goal and say that this is in 10 years from now or 15 years from now, I want to have a certain corpus. So let me show you how do you work backwards. Can I have the next slide, please? So if you're looking at a 15-year time frame and you are looking at 12%, you only have to invest 99,000 rupees a month. If you have 25 years to retirement, you only have to invest 26,000 odd rupees a month. So the earlier you start, the better. And it's not just about retirement planning, because you'll have other goals also that you'll have during the course of your career and your life, that you can, keep adding the money towards that kitty. So it's important that we all recognize and not put away the decision of saving and investing, and start investing right now. The next slide. Like Mr. Warren Buffett says, time in the market is more important than timing the market. I mean, we've all seen the markets go through turmoil thanks to the Russia-Ukraine crisis. But this is the time to actually not pull out money and keep adding, because the longer you stay invested, the more money you make.
Great, Gitika. I think that was indeed very well explained. I think one of the things that you mentioned, it's important to start early. Do you have a suggestive age group that one should begin at?
I mean, I would say start at the earliest. Start when you start working, your career starts, when you start getting that income. And not, I know a lot of youngsters want to enjoy life the first few years, but if they get into the discipline of investing and saving and investing, I think it'll hold them in good stead over the years. So the sooner the better.
Great. All right, Gitika, thank you so much for explaining it so beautifully to all our attendees and the live audience. So before we end this discussion today, I would like to sort of reach out to each one of you and, give us just this one piece of advice that you think would help us in planning our investments better. So starting off with you, Mukta, if you can and give us your advice.
Well, I would like to give a very simple advice to everyone out there. We have one thing always with us 24/7, which is the smartphone. And these days, we all just download all kind of apps on our phones, whether it's for consumption purposes, shopping purposes, etc., or food techs, etc., that are there. Also look at downloading the apps which help you into discipline. So download the budgeting apps, download the expenses apps, download the investment apps on your phone, and ensure that whatever you are saving, ensure you budget out for yourself, and ensure you invest every single month, if possible, every single week. If you have monies coming in, do that. That is only going to bring in discipline. Investments can be made in the smaller denominations as low as even 500 rupees. And it can be done very easily these days due to the use of technology. So yes, I would say bring technology to your best usage by downloading applications either on your phone, or if you're comfortable on the laptop, I would say that.
Perfect. How about you, Arti? What would your advice be?
I'd just like to say, that many a times financial planning, especially for women, is, like I also said, women started during the pandemic. However, it may start, we always sort of sometimes think of for women investing more from, contingencies. I think it's important, and I think it's all changing now. But like I said, we need to change more and more. So one needs to make a plan for happy things. So, we have our nanni khushiyan. So we have things like splurging on that holiday with friends. You want to buy that favorite piece of jewelry or your branded watch or sunglasses. So that should become, like I said earlier, our short-term goals. And the badi khushiyan, which would be, investing in a house or going on a world cruise or Alaska cruise, or, whatever it might be for each of us. And to help us, especially with the long-term goals, and I'm again coming back to that because I think in general, women tend to be risk averse, and they tend to shy away from investing in equity markets. Some people even say, oh, investing, I don't understand it. And this is like a bit like gambling also, I've heard. But I just like to say that's not true. We should not worry about investing in the equity markets. Start slowly, invest small amounts to gain confidence, but don't shy away. Equity is really the only asset class which will help you beat inflation. So keep investing, even if it's small amounts, like Mukta said, systematically, and plan your asset allocation according to your goals. That's what I'd like to advise.
Thanks, Arti. Gitika, over to you.
Well, the one piece of advice that I'd like to give is, again, on the lines of retirement planning. Women should ensure that they add in that health insurance and life insurance when they do their planning, because that is so important, not only for themselves, but for the family members, because one illness in the family can drain away all your reserves. So it's important that you plan and, seek help from a financial advisor and do a holistic planning, not just for retirement, but for all buckets, basically. And the time to start investing is now.
Perfect. Thank you so much, Arti, Gitika, Mukta. Thank you for taking time out. A big thanks to all the attendees who've literally stuck through from start to end. I barely saw any drop-offs. And to the Facebook audience who's joined us. I hope all of you have a wonderful Women's Day. Thank you so much for being here and giving us these
Thank you,
insights.
Bhavna.
Thank you. It was lovely. Thank you.